Okay guys, so in this video we are going to cover introduction of conceptual framework. So if you are talking about a conceptual framework, basically this is an introduction if you are doing accounting standard. So let's start with our example of today. Okay, it was question 1. Deal Pty Ltd is a manufacturer and a supplier farming equipment. Deal Pty Ltd is incorporated under a Company Act of 2008 in 2012, okay, and it operates within Limpopo province, okay. And then they say that the financial reporting period end of Deal Pty Ltd is 31 December. Every year reporting period they're saying that is ending 31 December, okay. A company is not registered for VAT and trade only with non-VAT vendor. In other words, they're saying that whenever you face the transaction, if there is a VAT implication, you need to ignore it. Okay. During 2016 reporting period, the following transaction, among others, okay. And on 5 February 2016, Deal Pty Ltd obtained a loan of 3.5 million from local bank Pty Ltd, and the interest is payable on this loan is 15% per annum. So this is the transaction number 1. So what you need to know about conceptual framework, guys, is that please make sure that you know the definition of assets, know the definition of liability, okay, know the definition of expense, as well as income. So make sure that you know all this definition. You can also know the definition of equity, okay. So now what we are going to do, we are going to do question number A, which stated that discuss with the reference of the conceptual framework whether the transaction above results in assets, liability, income, or expense being recognized in the financial year of Deal Pty Ltd for the year ended December 2016 for 12 marks. So guys, if you find a question like this one, it doesn't mean that you need to copy the whole definition of an asset. You are going to waste a lot of time, especially if you are doing a third year. Unless you are doing your first year, that's where they can give you a marks for definition of an asset. But for second year and third year, there's no marks for that. Okay, now let's identify the components so that we can be able to identify whether it's an asset, liability, expense, income, or equity. They said that on 5 February 2016, this company obtained a loan. The first element is loan, obviously. Okay, the second element, remember we got a loan, which means that when we borrow a loan, when they give us money, obviously we receive it from the bank, which means that the bank is also affected. Okay, however, this is not the only two, guys. The other one that is going to be affected is interest, because they said that we need to pay 15%, which means that interest expense is also affected. And the interest increase what? Loan. Although this is a repetition, we can't discuss them twice. All right. Because remember, guys, these two, they are going to form one journal, and these two, they are going to form another journal. You have to make sure that you are able to break down all of them, okay, under each transaction. Okay. Then now we have break down all of them for transaction number 1. Then for transaction number 2, they said that, then after that we're gonna go to discussion. They said that on 1 July 2016, Deal Pty Ltd acquired machine for 5 million for cash, and the machine is depreciated on straight line basis over 10 years. All right. Then the first one that is going to be affected in this case is machine. We bought machine. How did we buy this machine? We bought them cash, which means that bank affected because we take money and buy what? Machine. Is number 2. Then number 3 is depreciation. depreciation is going to be affected. Okay, you know that when you do the journal of depreciation, we don't just debit depreciation. We also credit what? Accumulated depreciation is one of the element. Accumulated depreciation is negative assets. Okay. Now we are done laying down all these elements. Now it's very simple. I believe that is going to be very simple. What you do now, you have to indicate a loan is liability. Loan is liability. Bank is asset. Simple interest is expense. Loan is liability. Machine is asset. Bank is asset. Depreciation is expense. Accumulated depreciation is asset as well, but this one is negative what? Assets, but it's assets. But remember, the accumulated depreciation, we subtract it from what? From the cost price of what? Of our assets under what? Under non-current assets. But this is assets in a negative way. Remember, if we don't have assets, we can have what? Depreciation. Simple means that accumulated depreciation is also part of an asset. Okay, now because we have them down like this, it's simple for you to do what? To put a discussion. Now it's easy for you to conclude that why are you saying loan is liability? Because we need to do what? To repay it. But guys, remember, under conceptual framework, you need to link it with what? With your definition of liability, which means that when you discuss, you are just going to discuss it in a summary way. You don't go there and say it, asset is a resources controlled by entity in which economic benefit are flowing what. No, you don't do that when it comes to discussion. You are doing a discussion, but in a summary way. Okay, bank. We already identified that bank is what? It's an asset. There is an economic benefit. There is an economic benefit from cash we receive. Okay, that's kind of discussion that is needed, not the whole definition, guys, unless you are doing first year. Then interest expense. Obviously, this one is going to reduce what? Reduce an asset or decrease or increase what? Or increase liability. Remember, if we incur interest expense, it's either we say that our asset is going down because we're going to pay them in terms of bank cash, or liability is going to be affected. If we didn't pay interest, liability is going up. Just like that. Loan for liabilities, the first one, machine. There is a benefit on this machine because we are going to produce more goods. That's what you need to discuss. Bank, we already discussed it. Depreciation is going to decrease what? The value of our assets. Accumulated depreciation is going to reduce the value of our assets. All right, that's the discussion that is needed here. Not to copy, because guys, I have noticed that some student, for example, we have an asset, the bank here. They're going to copy the whole definition for this first part of discussion, this bank. And when they come here for machine, again, they do the same thing. Recopy that definition as it is without even linking what? The scenario. Guys, you have to make sure that you link with the scenario. For example, the cash that we receive cash of how much? You can also mention that there's a benefit from this 3.5 million that we receive. Because this 3.5 million that we receive, we can acquire more machine so that we can produce more what? More goods that we are going to sell. Or this 3.5 million, we can use it to expand our business. You get my point? That's how you should discuss this part, unless they said that discuss the definition of assets in terms of this transaction. That way you can copy the whole definition. Okay, now let's proceed. The number 2, they said provide the journal entry to recognize each transaction. Guys, if you manage to identify these elements, it's going to be very simple for you to do the journal entry, because these elements is the same one that we are going to use to do it, to prepare our journal. Okay, let's start with journal number 1. We are going to say it, we receive cash, which means that we need to debit bank and credit what? And credit loan. Remember, we are using this principle that we use from high school. Assets, owner's equity, liability. It's a plus, minus, minus, plus, minus, plus. So our assets increase on the debit, we debit. Then credit loan, because liability has increased, then the amount is 3.5 million. 3.5 million this side. Then after that, we needed to calculate the interest. Interest, they didn't give us amount, but they give us the percentage of 15%. Okay, which means that we have to say debit, interest, expense, then we put a loan this side. So we're going to say the amount of 3.5 million multiplied by 15%, and we need to count a month, guys, because this loan was taken on 5 February, which means that it's gonna be 11 out of 12, because our year is ending December. Okay, I didn't calculate this, but I can calculate here so that we can get amount. 3.5 million multiplied by 15% multiplied by 11 over 12. Then it's gonna give us the interest of 481,250. Okay, 481,250, 481,250, just like that. Okay, then the next transaction, we have to recognize a machine that was purchased. Machine and bank. Remember, guys, please make sure that you indicate here SFP, SFP, P&L. This one is SFP as well. SFP, statement of financial position, profit and loss. Statement of financial position, statement of financial position. Okay, a machine, we purchase it by 5 million. 5 million. Okay, now the next one, we have to debit depreciation, and we credit accumulated depreciation. Okay, it's P&L this side and SFP. Okay, depreciation is not given. We need to do what? To calculate. They said that our depreciation is we are using a straight line method, and we are using over 10 years, which means that we need to count a month as well. It was purchased on July. From July up to December is going to give you 6 months. Okay, let me calculate. 5 million multiplied by so many percent. No, it's not percent. It's 10 years. Okay, which means that we need to say 5 million. Okay, let me write it. 5 million divided by 10 years multiplied by 6 over 12. Six over 12. Okay, then it's gonna give you 250,000. 250,000. So this is how you should prepare this conceptual framework. So this is our part 1, so we are going to do part 2 and part 3 as well. So please make sure that you subscribe and go and check other standards that I already covered. I'm gonna see you on the next one.